guys, welcome back to the Capital Mindset Show. Oh, hold on. My cat here wants some attention. Yeah. Okay. We're going to be discussing the semiconductors. And for those of you who may not know, the semiconductors have fallen quite a bit. And the three that I'm going to be specifically focusing on is Intel, Micron, and AMD. And we'll go in that order: Intel, Micron, AMD. So for those of you who haven't seen the video yet, we have a couple of videos on the channel regarding Intel. We do have one very early on. It's actually one of the first videos ever posted on this channel about AMD, and it discusses the supply chain issues. And we also have one on Micron. And actually, funnily enough, all three except for AMD are trading lower than when the videos were made and what my personal thesis or thoughts were on it. I'll say right off the bat, Intel has fallen not because of what I was concerned about, but for other separate reasons. And we'll discuss those in greater detail. So we'll start with Intel. All right, so Intel's popped down quite a bit lower. We saw the drawdown on Thursday, 1/27/2022. This video is being made on 1/28/2022. And basically, from what everyone should understand is there are greater concerns of margin compression, of supply chain woes, and of concerns of increased capital investment. Now, I'll first begin with the supply chain issue. Well, the supply chain issue has been available, or that information has been available ever since last year. And actually, in the very first video that was posted on this channel about semiconductors, we discussed that the supply chain issues won't start to correct themselves until 2023. I don't have any insider information. This was publicly available information from these same companies. All of them said the same thing about 2023. There was no crystal ball involved. 2023. So that shouldn't be of any surprise to any investor thinking about getting involved in the semiconductor industry. Okay, now going over to the inflation or margin compression, right? What we saw is margins have been compressing with Intel quite a bit. Okay, we saw the margins way back in the middle of the decade were in the 60s, and now they're in the 50s and approaching the 40s, right? What that is saying, or what that is indicating, right, to the market is that AMD is kicking Intel's butt. Okay. And not that Intel will die, but that Intel is fighting a tough fight. Okay. And you gotta, as an investor, you have to derive a story from the numbers, not just look at a number and say, oh, well, that's the margin. Okay. No, you got to ask yourself, what does that number tell you? What can you understand from that number? And then from there, make a good decision as far as regards to investing. Well, if margins are compressing, gross margins, that implies that either one, the price of the item is going down, or the costs to produce said item are going up. Those are the two possibilities, right? So for Intel, what investors are really concerned about, or what the market is concerned about, is that the pricing pressure with competition is forcing Intel to lower prices and thus lowering margins. And then inflation isn't making things any easier, because you have the producer price index is actually rising faster than the CPI on official numbers. I won't get into like if you believe it's not official or not, but the producer price index has been rising more. And then so we can kind of expect some of those costs to be experienced by something like Intel. Now, the third thing is that capital expenditures are expected to rise. Well, this also shouldn't be of a surprise. Intel announced that they were going to be doing this. And now that it's happening, cash flows or owner's earnings is going to be coming down, of course, because greater CapEx is necessary for them to build out their fabrication facilities so that they can produce the chips in-house, and they can also go to other businesses and produce their chips, such as, for example, NVIDIA, or maybe even AMD, you know, a bunch of other companies. Qualcomm, I know they made an agreement with Qualcomm. So they're investing about $20 billion in the United States alone to build out these fabrication facilities. And that should have been to no surprise to anyone. But, you know, the market's kind of maybe a little bit surprised, I guess, when the number, and that should kind of throw away a little bit about the idea of efficient market hypothesis. Of course, that is a hypothesis I'll put a pin on and talk about in a later video, because it's a little more complicated than that. I'm kind of oversimplifying it there. But for the most part, that's what you got to understand about what's going on with Intel. All right, so I will actually pull up the price action to kind of show us that. All right, so we take a look here. Intel Corporation right here, they've actually fallen quite a bit over the past 5 days, right? They were in the 50s. This is actually when I liquidated. You guys can go back to the video. I don't remember what the date was. I'm not going to just go out and pull it here, but it was in the 50s. I think it was 54, 53 where I sold, and I didn't sell for the reasons as to why it's going down now. It's completely unrelated, and I'll discuss that actually separately because it pertains only to Intel and not to Micron and AMD. Okay, but they sold off for very different reasons. I wouldn't have expected this myself. So we see this little bit of a drawdown, and remember that in a liquidity crunch, which we've been describing on this channel for quite some time, the pressure on companies to produce really good earnings is greater than ever. Okay, the market's going to be a little more strict on you in events like this. So this is again why capital mindset, we're like more cash heavy or cash proxy heavy, and we're just looking for the deals. Okay, so there is a point in which I will re-enter Intel, or the point where I believe Intel. Oh wow, sorry guys, Tesla's down 24% today. I should probably discuss that one too. But yeah, for the most part, Intel is coming down a little bit, and for those reasons that we've already discussed. So we'll just hop right into the model and kind of discuss some of the little nuances, right? INTC. I'll zoom in. I understand that the model needs to be zoomed in because I'm on different resolutions. All right, so Intel Corporation is set at a hold with a $55 price target, implying 20% upside. So it's a lot cheaper than before. And in fact, if you were interested in Intel before, you should be more interested now. Okay, remember, do not panic when everyone else is panicking. So let's imply a 12% required rate of return. They've averaged out growth of about 5%. Let's actually say that's the high. Okay, so no bueno. Look at that. Intel, if they have to accelerate growth. So let's be a little honest with them, and not honest, but like let's be a little more optimistic with them. All right, so Intel's not looking too good, if I'm being honest. So, you know why? The cash flow just came in. They're investing a lot in CapEx. Okay, so so now the model is going to be kind of punishing them a little bit more. And this is kind of, again, why you can think of the market as kind of punishing them, because if you know that they're going to invest a lot more in CapEx, that reduces the owner's earnings, and thus we're discounting at lower rates. Okay, or not discounting lower rates, we're discounting at a lower baseline. And so yes, it's the cash flows are just lower. Okay, so let's if we don't want to normalize it, because those are cash expenses that they will do. Now here's my problem. If I'm going to actually talk about it now, the reason why I liquidated my Intel position before, and you can watch the video when I did, and I explained it a little bit, but I'll try to explain a little bit better here in a short time frame. The reason why I liquidated Intel was I didn't agree with management's decision. Okay, so management decided to sell off an asset and then use that money to pay for these investments, right? Well, I completely agree with the investments. I want them to make necessary investments to actually grow their fabrication facilities and their fabrication presence in the United States. I disagreed by the way they went about it. So what I would have preferred them to do, and this is actually more of over the short term, it'd be terrible, right? Okay, let me be very clear. The stock price probably would get heavily punished over the short term, but over the long term, I think it would be highly beneficial to shareholders who would have stuck through or added in. And I would have actually liked to have bought more Intel had they had done this, and I would have had more conviction. But I'll discuss perhaps reasons as to why the CEO or the management decided not to do this. So they could have, for example, stopped the buybacks. They could have seized the buybacks and used that money to invest in the fabrication facilities, which would, if they stopped the buybacks and the dividend, it would have been close to $10 billion per year that they would have saved, and they could have put that into the $20 billion investment into the fabrication facilities. We got almost half of the money right there. And then on top of that, they have a very decent amount of cash after networking cash, right? So the cash they need to keep the business running day to day, they have plenty of cash after that. And then they could have done that, or they could have, taken on debt at very low rates. It's actually the best time to do that if you think something is a good investment. Right. So the reason as to why is because if any of us believe that self-driving cars is going to be something in the future, right, then Mobileye would have been a good asset. And they were touting it as a good asset for a very long time. Now, you could also argue, right, and this is a very valid argument, that Intel's management is so incompetent that they would have destroyed the value with Mobileye, right? But then if you go with that argument, then what are you saying about Intel's management? You see, so if you say that they should have spun it off because they wouldn't have been able to realize the value, what are you then implying about Intel's management? Well, you're implying that they're not good, right? And then so why would you trust them with anything? Why would you even invest in this company? Because why would you trust them? If you don't trust them with Mobileye, why would you trust them with the main core business, right? They're not going to execute, is what you're trying to say. So the other thing, the other third argument, which is also it's also pretty valid, is the market would have paid a high multiple for Mobileye. Well, that's not the case anymore. I really doubt that that's going to be the case now. And hindsight's 2020. But at the time, I don't like it when management makes those decisions based on that. And this is why I don't think the market is now going to pay such a high multiple for if it is a speculative asset. Why would they pay such a high multiple? And I think Mobileye, under the hands of Intel, if management is competent, could have been something great, right? Could have made necessary investments and been something that could have generated the company large sums of profits over the longer term. And again, there were other avenues for them to acquire the capital. So that was my main issue. I disagreed with management. And I think for everyone, if you don't agree with what management's doing, don't invest in it. Simple. You could be wrong, but there's so many opportunities in the market that you don't waste your time with things you just don't agree with, right? If you don't agree with it, don't agree with it. And if it goes up, who cares, really? Who cares? There's so many different opportunities. In this case, it actually was a capital save. I got over the short term, right? For now, I saved a lot of capital because I didn't have that, and I actually made some profits. Okay, but this sell-off is not due to that. Okay, so this sell-off is completely unrelated as to the reason why I sold. All right, so basically the model is going to basically take a poop on this investment simply because the cash flows are coming down, and they're expected to come down going forward because they have to make necessary capital investments. And you know, that's kind of unfortunate, but yeah, that's just how it be. All right. So let's assume that management can actually execute and they can grow at 15% cash flows going forward because of all the investments that they make. Well, if that were the case, then the 12% required rate of return makes sense, right? And we'd actually be at a buy zone. Okay. And then let's see if we can do a 12% growth. No, we can't do it just yet. We're almost there. 13%, we are there. So if we can assume 13% growth in cash flows going forward, that'd be interesting. All right, they didn't want to stop the buybacks. So let's assume the buyback of 2%. So 2% of shares are deleted. And it doesn't really change the scenarios too much. Let's actually go to 11%. Okay, so 11 now is good. 10 is good. And 8. All right, 8 is not good. 9. All right, 9 is almost there. So a little above 9 is actually what we can imply if we assume that they're going to continue the same level of buybacks, and maybe their buybacks become more effective as the price continues to fall, and then that percentage of deletion goes up and up and up. And I'm not assuming you reinvest the dividend or anything like that, and you compound in that capacity as well. So Intel, you know, it's looking good. I just wanted to cover that. That's why the stock's kind of coming down. It's because the cash flows are coming down, capital expenditure. It's a good thing, but I didn't agree with how they went about it. Okay, so next one we'll go over is Micron. So Micron, this is another one that we did a video on when it was about $85, $84. And I said at the time it was expensive. I didn't quite like it too much, but I like the business. And the problem was I was completely wrong. Look at that. I was wrong for a time, right? So it went up 13% before it actually came down 21%. And now we are 10% down from when I said it was overvalued. Is it at the price? Is that at the appropriate price now? Let's find out. Okay, so that's just kind of a summary of the price action. And we're in the Micron sheet, so we don't mess with AMD. AMD will be next. As soon as it loads, let's go and put our 12% discount rate. Buybacks, we're going to assume no buybacks right now. Let's look at the average growth rate. The average growth rate has been 10, so round that to 11%. Yeah, so this is kind of what was going on with Micron. But, okay, there's a but. With Micron, I was repeating back to you guys, well, not repeating back to you guys. I was telling you guys in that video that there were some accounting shenanigans that were kind of going on. So what we want to expect is the cash flows will eventually catch up to the net income, right? And then let me explain. So if we go to the key ratios, and let me kind of remember exactly, because I had to rewatch the video, but I didn't. So you see this cash conversion cycle. So it takes a long time for them to actually receive the cash after the inventory has been given. And then the revenue recognition principle under GAAP, net income would be already recognized, right? Because as soon as you give the inventory, then you'll get the cash at a later point, right? So they're selling stuff to, like, you know, for example, Dell and then HP and then they build their devices, or Microsoft, or even Apple. And then they build their PCs and then they pay them later on a later date. Okay. So then that causes a little bit of a problem with revenue recognition, right? Differing from the cash flows. Okay. So the cash flows will always look lower. Well, it depends. It actually depends. I shouldn't say that. But the cash flows in this instance look lower than what they are, or what they will be, because they're recognizing the income, but the cash flows aren't catching up. Okay. So if I go back to the summary report and we take a look here at the PE, see the PE looks really low, and then the price to free cash flow looks a lot higher. So the cash flows are not that good. But if you consider the net income or GAAP net income, it looks very cheap. It looks like a cheap stock. Well, that's because of the specificities of this company and how their business operates, right? And remember, in this channel, I say this all the time, nuance. Every single company can offer you a different experience, and it requires sometimes a different lens to look at it. Micron is, in this instance, like that. So if you are looking at the surface level analysis, you're going to miss this. And then if, you don't have to be an accountant, but it's good to hopefully learn. And I hope I'm helping you guys with that, learning these little accounting details. And so how that can impact your investment analysis going forward. So Micron, and I'll repeat that again, just in case I went over it too fast, has a long cash conversion cycle, meaning they're not going to get the cash until much later, right? That's one of the instances that gives you a hint. And then we take a look at the PE versus the free cash flow. Normally, that's not a good thing, but in this case, you kind of have to understand, why is that difference there? Well, because the cash comes later. Okay. Then when we understand that, then we start to say, okay, we can probably go to the publicly available information, and let's actually go to the revenue and then net income. So then let's actually go to the cash flow statement, and then we see net income here. So net income's there, and then cash flows from operations, it's 4 versus about 7, right? So it's much lower. It's about 3 billion difference. So what's going on there is the cash from operations is only recognizing the cash that comes in and out. That's it. So if they're not getting paid yet, the cash, then it's not going to be in there. But the GAAP net income, GAAP recognizes on an accrual basis. Accrual basis of accounting stipulates or takes into account the timing of things. So if you do a service, right, and you charge money for it, then you will recognize the profits or the sale upon the delivery of the service or the sale, right? That will count as revenue, but you may not get paid in cash yet. Okay. So small businesses operate on the cash basis of accounting for the most part. I'm talking about large enterprises. So you will not recognize the sale or the revenue until the service is done, right? Or until the product is delivered in some instances. And that's called the revenue recognition principle. Okay. So we got to understand that with Micron, the cash isn't here yet. Okay. But it's coming. Okay. So when we go back to the model, we understand that nuance, and then we come here, and then we can probably increase our growth rates. They're actually going to grow faster because they got to catch up to the net income. Okay. And then that's why sometimes it looks expensive. And this is what I think the super investors see in this business, that the retail investor might look at and go, okay, I understand the cash flows are, really high. I mean, in this instance, the PE is a little more precise in its explanation of what's going on with the underlying business. So let's assume, 15%, right? So with a 15% growth rate, which is actually more probable than the average 10%, because again, the cash flows are going to catch up. We're seeing that it's already kind of a buy with the 12% required rate of return. Okay. And again, by the way, this is well capitalized. I should have went over Intel, but Intel's well capitalized, by the way. So I just want to explain to you guys a little bit of the nuances, repeat some of the nuances for those of you who may not have seen that video, and kind of give my thoughts on why it's coming down. Okay. So they're coming down for more or less the same reason: supply chain. And again, in this environment, you have to understand that things are going to get more punished if things aren't perfect. So things right now have to be kind of perfect. Okay. Which is why, again, I've been cash or cash proxies for quite some time. That's been the strategy for now. And then I'm hunting companies to buy, right? And there are some on my list. There's a video that had probably already came out, and I'm starting to buy that company. Okay. So we're looking at Micron. I'm not going to add any buybacks, but for the most part, I just want to show you guys if we can assume 15% or more, we're good. If we want to increase our rates of return, we got to assume higher growth rates. I think can we assume a 20? We can assume a 20. What about a 19? Let's see a 19. All right, we're almost there for 19%. So between above 19, slightly above 19 is what you'd have to assume in order to get that 15% required rate of return. Is it possible for them to grow like that? Yes, because once we understand that little discrepancy in the cash flows versus the GAAP net income. Okay. Again, if you have any questions on all that stuff, comment down below. I'll do my best to respond in a timely manner. I know some of that stuff is for those of you who didn't study accounting or finance in university, sometimes the jargon, and I apologize for the jargon. Okay. So I'll say it in a different way in the comments. But I'm trying to be cognizant of that. All right. The last one we're going to go over is AMD, right? So AMD, essentially what's occurred with AMD is more or less the same thing. It was kind of priced for perfection. And this is another one that when we spoke about it, it was actually around here. And it was one of the first videos. And basically the conclusion was overvalued. However, we were wrong and it went all the way up. It went up 59%. Look at that. Look how wrong I was, right? Terribly wrong. And the model was wrong. Everything was wrong. And now we're right back to where we were. Okay, so now we're at the same spot, and I assume the fundamentals have improved. They probably grew since then, and so the model might be not as bearish, but it's going to be a little bit more, still going to be cautious, I bet. Okay, so let's go here and actually see what's going on. And by the way, same reason: supply chain, blah blah blah, inflation, blah blah blah, all that. So let's put the 12%. Oh, by the way, it's a buy by the analyst. So, there you go. That's all you need to know. 12% required rate of return. You see, this is definitely not priced for no growth. If there was zero growth, you have to buy this at 21. So yeah, I remember when I bought AMD, it was my birthday on 2017. I won't say when my birthday was, but it was my birthday, 2017. I bought AMD for about $12. I didn't hold all the way through, guys. So I'm not that much of a G. I sold way earlier. I think I sold in the 80s, something like that. But anyways, taking a look here, let's can we get 10%? No, we can't even get 10%. 15. No, we can't get 15. 20%. I should have started with 20. 25%. Okay, so 25%, we are good to go for that. And they've averaged out 29.2% over the past couple years. So let's actually assume the 25 is in the middle, so a little bit slower than before. We're being a little aggressive, maybe. Some of you might think that. And then let's do the 20 or 22 and then 20. Because I do think they have a huge runway, but how much of a huge runway is it? And then let's do 30 on the high end. So that's the average, what they did. Will they achieve the average? I don't know. Maybe. That's probably what the market thought, and that's why they got so high. But, things are changing. Anyway, so the analysts say it's a buy with a 142.5 price target, implying a 39.1% upside. So let's assume, they are diluting. I'll assume no. I'll assume they don't do that. But to be honest, if their stock is overvalued, the management should be doing that to lower the cost of capital. Look at that Coker. That Coker is insane. Okay. That's very low. They're using equity and debt, and they're getting really good rates. Okay, so they are using actually more debt than equity, and that's probably indicative in the key ratios. Actually, you know why it's doing that? Yeah, it's doing that because it's probably more recently they haven't been issuing shares. Because look here, the debt ratio is very low, so they're probably now issuing pretty much no shares. So that's probably why the model is actually saying debt heavy. But that's why I always check everything. I don't just take everything at face value. I like to check multiple parts. All right, so they are actually same thing. PE of 31 and price free cash flow 42. So if we go to the key ratios and go down here, we'll take a look at that cash conversion cycle, and there you go. That helps to explain a little bit. And it's a little bit of the nuance of the semiconductor industry. So they deliver the product, they recognize it on their net income, and then they don't get the cash until about 91 days later. Okay, so that's, again, the cash conversion cycle. It's when they churn inventory and then into cash. It takes them 91 days on average. And then they had days where it was better, 34, 64. This is probably supply chain reasons. So they probably generate the sale, and then they deliver the product, but then they don't get the cash because, I don't know, the PC is not built yet or something. I can't really explain why, because I don't run the company. But If one of you works at AMD, you can probably maybe explain it on a management level if you understand, like, or you're working with the inventory, you can probably explain that. But anyway, going back to here, yeah, we do have to assume a strong amount of growth. As soon as we increase our discount rate, we have to then definitely assume higher growth rates. And the question at the original video was, are you comfortable with implying a 30% growth rate for the next 10 years? That's how you would achieve. And you can't assume any dilution, because if we do, just to show everyone, let's assume 2%. Immediately, nope, doesn't work anymore. We'd have to grow even faster. We'd have to have growth acceleration, right? 40% is a little too crazy. Let's go a little lower. Okay, let's go a little lower. See what it's priced for, what would make sense. And I'd call that, yeah. Let's do 33. All right, 33, 32. You'd have to assume that, and then you can assume the 2% dilution every year for 10 years. Okay, so that pretty much covers all these three stocks. Again, to summarize, Intel went down not for the reasons why I sold. I sold for my disagreement with management. I don't think that Intel is a bad business per se. There's plenty of opportunities out there. So, you know, if I choose not to invest in Intel, it's not that Intel's bad. It's just that I just don't agree with them. Okay. You can definitely invest in Intel and make tons of money. Same with AMD. You know, I just shared my opinion about it, but you know, for all that's worth. And then same with Micron. So Micron, I think of all of them, is the one I kind of like perhaps the most, because management's making really good decisions, in my opinion, as far as how they're investing. And they just started a dividend, but you know, it's a token dividend. It's a little cute dividend. And I think that of the others, however, Micron is the most susceptible to commoditization, because they don't really have any differentiation in their products. Sure, they can improve the quality of the said product, but memory is memory is memory, and anyone can produce the chips. They just have to do it more efficiently than everyone else. So they are improving how they invest in CapEx. But for example, Intel has more vital products, such as the CPU, and they're getting into the GPU space. So that's fantastic for Intel. So you see, I'm not trying to say one is always better than the other. There's like so many different factors I think about. AMD is the rising star. As a business, they're kicking butt. Like, they're destroying everything in terms of how they're operating. So fantastic business. Is you have to separate the stock from the business though. And at the present moment, even at that early video, the very first video about AMD, it's just the price isn't there for me to say it's a great investment for me. So again, when I made that video, it went up 60 something percent. So, but right now we're back down to the same level, and I'm still not interested personally, because I'd have to make too many crazy assumptions. On that note, guys, I hope you guys have a good one, and I'll see you guys on the next one. Bye.